So you sound broadly positive here, Eric. Talking about the market, you say the time for being cautious is behind us. How come, Eric? Walk us through it.
Yeah, I think it's been certainly a litany of information, Josh, for us all to try to digest. But the measurables that we pay attention to for all the things going back and forth in Washington, the consumer is still in relatively good shape. We think that businesses are also in good shape. So without question, the profit cycle that we've all been accustomed to has some work left to be done. We certainly got some good information from Walmart last night in terms of pass-through of price increases. But based on the data we pay attention to, so things like TSA travel and credit card swipes and restaurant openings and Indeed.com job postings, it's still a decent environment. So that recalibration, I guess I'd put it more in the sense of adaptation and adaptability by consumers, seems to be intact. So that's why we're still glass half full. We've oscillated between being either overweight equities or neutral right now, but certainly with a slightly more positive bias. We think that's probably the way that investors should be positioned as well.
Eric, how would you generally characterize valuation here broadly?
Yeah, I think if you look at the S&P, for example, clearly, 20% ago was a lot more attractive. But I think that right now, based on historical metrics, we're about, a half a standard deviation expensive. That's not, out of the realm of possibilities. Certainly in an environment, Josh, where you do have interest rates probably stabilizing to slightly coming down at the front end of the curve, that does give you a little more justification for equity prices to really warrant a slight premium on a valuation standpoint. The things that we find most attractive on a pure valuation basis, again, valuation is not a catalyst, but if you look at international developed, that's certainly an interesting spot. We think that financials, specifically in the US, are certainly inexpensive. We think the yield curve probably comes in a better place for financials. So across sectors versus across broad markets, we think there are certainly pockets of opportunity, and so financials is certainly one of them. I think the technology, which of course garners a lot of investor interest, that has become much more attractive to us. We think that CapEx, Josh, has been very intact. One of the things we've been really adamant about tracking is just what are corporate commitments for things like cyber and AI spend. That continues to be a consistent message from companies. They're not giving that up. So we think that there's actually some underpinnings in tech. There are certainly parts of the technology space that got really inexpensive during the April downdraft. So we think technology deserves a place in client portfolios as well.
Eric, Adam Johnson, good to see you. And I think you and I kind of view the world similarly in that we're optimists. We see a lot of opportunity. You mentioned that April downdraft. Why is it, you think, that people got so downhearted and just so negative and so convinced that the end of the world was nigh? What was it about April that scared people so much?
Yeah, Adam, you did a great job in the prior segment kind of talking through the zeitgeist of investors. And I think that sometimes institutional investors suffer from the curse of knowledge, because they're so close to the action. There's always this desire to do something. And again, to be sure, there's the case that we had to really put as a potential outcome of the administration really pursuing onshoring of manufacturing, as well as a very hard line on the negotiation front. That was really the mantra between April 2nd and really the intraday period of April 9th. I do think that the administration understood that markets really don't care about Democrat versus Republican. They care about, what is in it from the corporate profit cycle standpoint. And so once the administration saw that markets really weren't going to allow as hard a line to be taken, I think that was the response that we needed to see to keep that glass half full perspective intact.
Eric, I'm curious, in the stock market, you mentioned some sectors you like, so financials, tech. What are some sectors, Eric, you're less enthusiastic about here?
Yeah, I think that, probably the top would be on the staple side, Josh, just because, it is certainly a little expensive and certainly a proxy for bond yields, which we think is probably less of an opportunity. We think that was probably more tied to the defensive trade, if you will. I think that utilities have gotten a little bit ahead of themselves as well. Obviously, lots of focus on data centers, lots of focus on cash flow coming from utilities. That would probably be an area we're less enthusiastic of. I think that the sector that is probably the swing factor would be the retail space. Obviously, was caught in the downdraft for lots of good reasons, But we're really in the hard part right now in terms of this market deciding what it wants to do. Does it want to discount a consumer base that will actually just keep spending through the price hikes that are going to come in, again, more mollified than they would have been, but certainly still price hikes? Or will we see a market where retail is more of a trade? We do think that there is some momentum with consumers. We think there's a lot of bifurcation across lower income consumers versus higher income consumers. So we'd probably be up the quality spectrum a little bit, but we do think that retail offers some value. We think that's a spot that will not be just a short-term trade, but we'll see some more sponsorship as we get deeper into this year.
Eric, it is always good to see you. Always good to have you on the show. Have a great weekend.
Do the same, Josh. Thanks so much.